As a professional trader, you need to have certain edges on your side and certain probabilities in your favor. To accomplish this, we would need to delve into technical analysis even further. There are three basic concepts that make up technical analysis. 1. Understanding the trend. 2. Analyzing different patterns within the trend. And 3. Recognizing candlestick patterns. All three of these concepts are based on the psychology of the market, and you'll understand why in this video. Let's start by understanding the trend. A stock chart is just a reflection of how traders react at certain prices and the psychology behind their decision to buy or sell. By observing a few select repeated patterns that occur time and time again, a trader is then able to read what a stock chart is saying and forecast trades with a higher probability of success. The number one rule in technical analysis is to trade with the trend. The trend is your friend because it ensures that you're trading on the right side of the market and not against it. The trend allows you to buy a stock that has momentum on its side where demand is greater than supply. Stocks do not move in a straight line. Stocks move up and down every day. Therefore, we need to identify whether it is trending upwards, sideways, or downward. But how do we determine this? First, we need to understand the concept of support and resistance, which is fairly simple. The word support just means the floor. Let's say we're analyzing a stock for the past 6 months. Buyers may want to buy the stock at $50, thinking that this is a great time to buy the stock. So as traders buy, the stock price begins to rise. 2 months later, traders see that the stock price is too high, so they stop buying or previous owners begin selling for a profit, so the stock price goes down. Later, traders see that the stock price is back at 50 and want to buy it again, so the stock price goes back up. And then again, they reach a point where it's too high, so they stop buying or owners start selling, so it goes back down. In this example, if we draw a line across the bottom, connecting all the lows, we can see that $50 was the floor which the stock bounced off of for the past 6 months. The more times a stock bounces off the floor, the more reliable that particular price level becomes. Now, resistance is just the opposite. It means the ceiling. Instead of a floor that the stock keeps bouncing off of, the stock may meet resistance or a ceiling that it cannot break through. Using this same example, if I draw a line across the top, connecting all the highs, then we can see that the ceiling is at $75. As mentioned earlier, this occurs when traders are not willing to pay a higher price for the stock than before, or previous owners are taking profits at this level by selling their stock, causing the price to go back down. Now let's take a look at an example of a real stock chart. I've already drawn the support level, also known as floor, here at the bottom. As you can see, the stock bounced off the $181 price level 4 times in the past 7 months. Again, the more times a stock bounces off the floor, the more reliable that particular price level becomes. Now let's look at another chart. Here, I've already drawn in the resistance or ceiling. By connecting the previous highs, you can see that this stock has hit the ceiling 4 times and hasn't been able to fully break through. Pretty simple, right? So now that we understand the concept of support and resistance, we can now begin to determine the trend. Take a look at the following example of an upward trend. If the stock is trending upwards, it's going to reach its prior peak and eventually break through and make a higher peak, also known as higher high. A stock will repeat this cycle over and over again, where it continues to make higher highs and even higher lows. By connecting the lows of a stock to form the support, and connecting the highs of the stock to form the ceiling, you can see this stock is trending in an upwards channel. But why does this happen? Let's take a look at the psychology of the traders. As you can see, by the upward angle of the floor, the lows are getting higher and higher. This means that every time the price pulls back, buyers are stepping in earlier and buying the stock before it is able to retrace back to the prior lows. This is a reflection that demand is higher than supply at these prices, causing the stock to go up only after a brief sell-off. The stock is then able to push through the prior highs, or ceiling, to the left, forming a higher high. This occurs because traders are very bullish about the stock, willing to buy the stock as it makes new highs. By connecting these highs, you can then form an upward channel that the stock is trading in. Here is a real example of an upwards trend. The next trend to look out for is the sideways trend. This is probably the easiest trend to recognize. As you can see, a sideways trending stock bounces off a horizontal price support and hits a horizontal resistance level or ceiling. The stock is not able to break through the floor or ceiling, causing the stock to channel sideways. Lastly, let's take a look at an example of a downwards trending stock. This is just the opposite of the upwards trending stock. In this case, if we connect all the highs, we have a downward sloping resistance. The highs are getting lower and lower. Every time the price tries to go back up, it's met with more selling pressure than before, causing the price to go back down before it can reach its prior high. Demand is less and less as the price goes higher. You can also see that the lows are getting lower and lower. The stock is making new lows by breaking through their prior lows. So to recap, you learned the number one rule in technical analysis, which is to trade with the trend, the difference between support and resistance, and you're now able to recognize the difference between upwards, sideways, and downwards trending stocks. In my next video, I'll teach you the next important concept in technical analysis, which is learning how to identify specific price patterns within the trend.